This is eSec Money and Insights. Let's get over to our episode. Summertime. How we doing?
Finding it hard to even find people to talk to on the desk today. I think a lot of people took Monday and Tuesday off. Nice long weekend. It's been frustrating in terms of getting stuff done. I can't get a
So
hold of
you
people.
think the fact that you don't have anyone to talk to is more about them, not you?
Yeah, exactly. It's not necessarily that they're not in the office. They're just not picking me up.
That's what I was wondering.
It's a me issue. It's been lightly staffed.
We did just get through a holiday weekend. Were there any big celebratory activities that either of you partook in? No?
Particking. Not me. No, I had a relatively quiet
Oh,
fourth.
I did all the cliche buzzwords, sun and bear and pool and fireworks, all the good stuff. I'm coming off a 2 week or so. I needed it to be a little low key.
Okay, you're in recovery mode. Good. All right. Well, sounds good. So we're past another quarter in. We're into Q3 officially now, but we're also getting, as Jim, you're noting, into the height of summer and the seasonal effect that has on markets. But June was a roaring month for all sorts of reasons. Do you have a comment to say on that it was roaring?
Roaring? I didn't know. Is that a descriptive word that you chose to use, or is it a double entendre? Roaring? What was roaring about June? Roaring?
There you are. I'm not going to
Roaring?
say it again. I mean, there was a lot going on.
There was.
There was massive market activity in our market sector. Balances were about as high as it feels like that they've ever gone. If McNeil were here, he would talk to us about triple witch dates, a Russell rebound, what Mike would tell us about new Fed chairs sitting in, SpaceX IPOs, biggest IPOs ever. I mean, there was a lot going on. I think it was roaring. How about off the charts, Jim?
Off the charts. I like that. June was off the charts. And our clients were also active and busy and engaged. And so it made for busy and productive. Got a lot done from a trade perspective. Got a lot done in 1 month. Pretty pleased with that. July's starting off the same. We still have the same active conversations around funding, whether it's funding for brokers, trying to do our paired trades, or if it's funding for our clients or funding of long activity via E for E. We're engaged in a lot of different discussions with brokers about new trades and new balances for our clients. So excited about that. Hopefully get a bunch of that, if not all of that, over the line in the next couple of weeks before everyone really takes off for the summer. SpaceX is out on loan. It's interesting, trading 25 to 50 bips. So not really a special, but certainly not trading like Apple or IBM. So good to see. Just got added to the NASDAQ. I believe trade date was yesterday. We'll see more supply hit the market there, forced buying. See if that new supply is met with new demand. I bet it will be. And then we head into the beginning of the lockups. I believe it's next month, end of next month, when things should start heating up from a borrow perspective, or at least if they're going to, it'll be start in August. So fingers crossed there.
Okay. Mike?
Yeah,
I know
I'll
you
jump
were
in.
out I knew you had your 2 weeker, but fill us in.
There was plenty going on in June. I think he kind of highlighted it. We had new Fed Chair Warsh's first FOMC meeting. So his first opportunity to address the media, but also investors and market participants alike. His first opportunity to, in theory, alter rates or give his forward guidance on rates. It was a pretty telegraphed meeting from an interest rate kind of decision perspective. I think most people thought it was going to be on hold, which it was. People were probably more interested in some of the guidance on the follow. I think coming into this, people thought the new Fed chair would be more aligned with the political administration, more on a dovish tone, wanting to decrease rates, even so much that might be bullied into decreasing rates. Remember, that was a very big point of contention between the past administration and the past Fed administration as well. I think as of right now, they'll get some leeway to kind of keep rates as is. I don't think there will be a overemphasis on cutting rates because right now the data does not allow for that. I think that's something positive from a Warsh perspective. I think right now we're probably at the neutral rate. I would be surprised if rates don't stay in this range for the next couple of months. I think even more so of we kind of have the unofficial end of the Middle East conflict. So now, as some of the data comes on a lag, particularly around energy prices and inflation, you'll start to see what the fallout of the economy and economic growth looks like from the Middle East. Extremely important data points of what the Fed's going to do next. I think there's still a lot of uncertainty because there's a lot of Fed officials who think the next move should be higher, and some would like to get ahead of that inflation fight maybe a little earlier. There are others who think maybe the labor data doesn't quite justify that and we should either be on hold or maybe cut at some point. It's kind of a lot to make sense of. If you're looking at just what's happening in the market, what trades are going through, swaps markets and OIS markets are looking at, I would say that right now the baseline is about one hike this year, depending who you talk to. You might get differing opinions on whether that's an accurate baseline. Markets look like it's going to be somewhere right now in the October to December timeframe. So obviously very fluid. We'll get a lot of information between now and the end of the year, but I think that's where markets stand right now. You're seeing a lift of yields across the curve. For us, we think that offers some interesting investment opportunities. I think when there's knee-jerk reactions in the market and things move faster on one or two economic prints, there might be some opportunity there. So we've taken some advantage of layering in a little bit of duration on the asset side, try to lock into some of these inflection points in FOMC meetings and take advantage of maybe a higher probability of rates that maybe we're not quite persuaded that they're actually going to tighten at some of these. Try to be a little opportunistic with it. Obviously, don't want to be too directional and get hit by maybe a Fed that moves in the opposite way. But I think when a market like this presents some opportunity, it makes strategic sense to take advantage of it. We also got through a quarter end. Quarter ends have been pretty anticlimactic for the last couple of years. I do think this one felt a little bit more historical, getting maybe late taps on the shoulder to go down some balances. Balance sheet just getting a little tighter. I don't think that's much of a surprise, especially on my side of the house, looking at the treasury market with where issuance is and some of the supply levels that dealers are being asked to keep on sheet. I do think it makes a lot of sense that some of their balance sheets are a little bit bloated and maybe not as able to intermediate the market as they once were when balance sheets as a whole were growing. Obviously, with bank regulation and the cost of balance sheet, that's increasing as well. I think also guys are being a little bit more diplomatic on how they deploy their sheets. So definitely saw a little bit more outflow this time around than in maybe the last couple of quarter ends. I do think it's a pretty good indicator of how the back half of the year is going to go. For that reason, I think we're going to keep liquidity top of mind and we'll try to get out ahead of these earlier in Q3 and in Q4, particularly Q4, because the year end always tends to be a monsoon of an event. So,
what are you comparing that to, though, Mike? Are you comparing that to what was the last quarter end or quarter ends last year?
I think we've gone enough time now in the post COVID world where, really since 2020, with Fed came in and were very accommodative from a monetary policy perspective. Cash was very ample around the market, put downward pressure on repo rates, and balance sheets were growing with the Fed technical tools they were using to manage balance sheets. So that boded pretty well for our borrowers' ability to intermediate the market during reporting dates. As balance sheets are getting smaller, the cost of sheets going up, and then there's more supply in the market, more supply, less cash to intermediate repo matchbooks, factors that drive up levels and decrease balances. And then there's this whole other part of the market, right, that sponsored trades are increasing in preparation of the central clearing mandate. I think that should help dealers' abilities to manage through some of these reporting dates. So I think that's going to be one of the solutions to some of the negatives of the balance sheet equation. So I think there's a lot of fluid things going on. I definitely felt more pressure this time around than maybe the last couple of years. And something we're keeping top of mind as we navigate. As Jim mentioned, balances are at intra-year highs. So you're asking dealers to bid more securities and give you more cash, where you're hearing more about balance sheet and cost of capital and things like that. So those tend to be conflicting factors and something you want to get out ahead of so you don't get kind of stuck late fourth quarter and have a lot of outflows, especially for those that are running large cash books, right? And then you have to start selling securities, too much cash, too short, that has a drag on yield and blowing through liquidity metrics and all that type of stuff.
If you were to, for your book of business on the loan side, highlight what might have been the trade of last quarter that you would have done a lot of or engaged with multiple counterparts on, what would that be? And do you think that's going to feel any different to this quarter that we're in now?
Yeah, I mean, on the pure lending side, I think it was a pretty friendly environment for the first 6 months of the year. So the first half of the year of raising term cash. I think the curve from 1 to 9 months was pretty flat. So your term premium, you're getting asked to go over certain reporting dates, and even the spread between overnight markets to term markets, I think, was pretty thin. If you had the ability to go out longer, hit bids and lock up funding, I think that made a lot of sense in the first half of the year, especially those who could mismatch it with assets on the other side and go 6 months, 12 months, 18 months on the asset side and have 6 to 10 months of funding lock in rather than funding your whole entire book overnight to try to get lower rebates. You have a massive duration mismatch there. So I think
Everything you
that
just said is mostly lending out treasuries.
HQLA, we've seen it in MBS markets as well, depending on your ability to give or get haircuts on the MBS side would tend to be how maybe the wide breadth of your borrower base there. We saw pretty good utilizations and pretty low rebates from a historical perspective in that asset class as well. Levels started to move up a little higher as we open up July here, but that's not atypical to how the back half of most years work anyways, which is why we did a lot of work in the front half of the year to lock in some pretty good collateral. I'd also mention anything in the secured funding space, clients that were able to take advantage of alternative repo trades, whether it's equities, corps, different ABS, CLOs, the structured product, things like that, or the typical downgrade trade using treasuries as well. A lot of articles of late in Q2 there about some of the stressors around the equity financing market that impacts on dealer balance sheets and swap markets and how forward markets and indexes are increasing and the cost of that going up. Any of our clients that can partake in some derivative of that trade, whether it's the actual swap itself, or doing it in repo, or doing a downgrade trade, anything that can help fund the equities, they benefited in the first half of the year. There's really no reason to think that that trade is going to end unless we have a massive reversal in valuations that has dealers less long certain collateral. I think the IPO space and SpaceX also added to that as well. So there was a lot of different technical factors that kind of all came to fruition at the same time here.
Yeah, I think that need to reduce sheet with equities via swap or futures or however you're going to do it has had a ripple effect on our desk. And the last 2 weeks, we've been trying to push out equities and raise cash for some clients, and I'm finding it more difficult than I thought I would. And it's not price sensitive, it's just not offered there. Meaning, if they're going to borrow needs, if I said, hey, let's do plus 20, plus 25, I think it'd be difficult, just as difficult as raising it in the normal stock loan area of flat to plus 10 type thing. And so it's purely driven by opportunity cost of that cash for primes. So they're using it elsewhere. I'm with Mike. Without soft US equity markets or the flow of IPOs to stop, more sheet is needed because it looks like it's going to continue. Unless that reverses, I think funding spreads and the use of balance sheet are going to remain well bid. So to the extent our clients can take care of it and we can raise cash for them.
Yeah, this was the first time I heard a few different avenues of people talk about this trade increasing and the use of the balance sheet for the equity financing markets increasing could have dealers redeploying their sheet more to this trade and could impact their use of typical treasury repo matchbooks and could put more pressure on funding markets and capacity. It was more of an anecdotal, I think, but something to keep an eye on as valuations increase and dealers looking for more funding here, which is why I think the more we can get creative, work with our clients, have structured solutions to some of these problems helps us not just that it's a great trade and it's a nice spread, but also helps us in tangential parts of our business as well.
Equity finance levels versus historical norms, are they 15, 20% higher now, would you say? Or if you're looking like 3 month and 6 month equity repo, what you're getting paid today?
I would say 20, 25% kind of more right now. If you're putting them on spot trade, obviously it's always interesting to look at your legacy book trades for multi-years, and all those trades are printed right around each other. And you can see some of the outliers on the book tend to be the ones that have been added recently. And it goes back to the first half of the year, really Q2, especially moving through June, that perfect storm of equity financing. You started seeing levels north of 200 heading into the turn. And then right after, I think it's back down to 60, 70 basis points there. Still pretty healthy compared to historical perspectives. I think guys are willing to pay up to get trades on and willing to pay up to keep trades on as well, because if you call them, they're going to have to find funding elsewhere. And I think a lot of people are getting tapped on the shoulder to help kind of partake in various problems, for lack of a better word, in this space. I think the elasticity of these trades are pretty strong there.
When we last podcasted, Jim, I think our last one was in Lisbon when we had a guest, Matt Burnett, on. At the end, he was expecting that I was going to come up with some random question, which I didn't. And so I think I disappointed him. So I don't want to disappoint you two.
Ugh. Here we go.
So my icebreaker close for the day is I want to know two things. What was your first paid job in life? And when you were a kid, what did you want to be when you grow up?
That's for
Well,
all three of us, right? So
Yeah, I'll go too.
my first cash paid job was cutting lawns for a friend's older brother who had a couple of mowers and a truck, and we would drive around and cut
What was your
lawns.
first payrolled job?
My first payroll job was in New York City. I couldn't find a job. I graduated in 91 from college.
Oh, so your
Job.
first payroll job was after college?
Yeah, my real job as opposed to like a summer intern, that
Well,
type of
yeah,
thing.
yeah, but like you
Oh,
were never on
well,
anyone's payroll? Like when
he
you
was
were,
a bookie
were you
since
always under the
14.
Oh,
table?
no,
I
I guess.
wondered. Was everything under the table?
Nope, you're right. In 10th and 11th grade, I
Me-
worked at the Gap
Oh.
in the local mall.
As a
Did
greeter?
you know how to
No,
fold
I
clothes
folded
then
sweaters.
well?
Yes, I could fold sweaters. Yeah, absolutely. I could
Okay.
fold jeans and stuff them into the wall. Yeah, I did it all.
All right. And still good at folding?
I
Like,
haven't
did
done it in
that
a
stay
while.
with you? Did that stay with you in life?
Yeah, it's a
I had a
skill, Brooke.
retail job and it just stayed with me.
You should see my sweatshirt and sweater closet here. It's very neat.
Is it
I have
color coded?
it is, yeah. And everything's folded. I have a little folding board and I fold them around the
You
board. Pull it
do?
up. Of course I don't, but I could. If I had one, I could use it. That was my first paid job. And what did I want to be when I grew up? I think I wanted to be a dentist. My grandfather was a dentist,
Oh,
and I thought that was a
okay.
cool job. And turns out I wasn't any good at science, and the medical field
Okay.
was not a go for me. So
All
I
right.
went into stock loan instead.
Okay. Yeah.
A
Yeah.
natural
That's been
And now
successful.
look at me. Look at this guy. Total legend.
All right. Mike?
Brooks.
Yeah, I think my first job on the payroll was a summer job for the city I grew up in, collecting trash and cleaning up the parks over the summer, like in
Okay.
tandem with their
Yeah.
summer
That
lunch
didn't
program.
come with an orange jumpsuit. That was
No,
sort
it
of,
did,
you
didn't,
could,
didn't come with an orange jumpsuit.
Or
It's
stick with a poker on the end, Mike. Did you get
I
one of
know,
those issue?
or the clamper.
orange jumpsuit. No, had the stick with the poker on the end of it though. 7.25 an hour, I think. So it wasn't too shabby. And I don't really have too many memories of what I wanted to be when I grew up. My mom will tell you that I wanted to be an ice cream truck driver because I thought that guy was really cool in front of my house all summer. Like I
That
thought he
seems
was.
a,
I thought he was really popular because he always had a big line out front, and everybody seemed really happy to go see that guy.
Uh-huh.
that seems like a dream you could have chased, Mike.
Yeah, I can still do it now.
I don't
The one
know.
that drives through our neighborhood is called Mr. Dingaling.
Yeah, that's my point. Everyone has like an idea of some version of that guy.
That can't be true. She had to make that up.
100%.
Well, that's what the noise
She
is.
does
right?
it
It's
for
like
shock
probably-
value, Mr. Dingaling.
No, he's called. I'm just like, how is he getting away with that?
All right, Brooke, you're up.
I'll take a photo the next time. This podcast has already heard about my first job, which was I worked at a place called Chick Sporting Goods, and it was in retail. So I'm also an excellent folder. It's where I got my first experience in sales and on commission, and I found that I loved selling because of that. But my first payroll job was a lifeguard. So I was a lifeguard and the swim instructor, but that's because that was my world that I lived in and grew up in. And what did I want to be when I wanted, which was probably the most ridiculous thing, because similar to you, Jim, there was no basis of reality. I really wanted to be a marine biologist because I really thought I wanted to work at SeaWorld and train the orcas, which for all sorts of historical reasons is probably a horrible idea. But anyway, that's what I wanted to do.
Marine biologist.
Yes. All right, friends. If you have real questions for us and you want to avoid my dumb questions, then you can submit via our website.
There's so many to get through.
I
The
know.
questions, you can't guarantee by the time we pod next, you're going to have gotten to the questions that people submit this week.
Totally.
Deluge of questions.
All right, everyone. Mike, thank you. Jim, thank you. We'll pod next time. Maybe McNeil will be back. There's also a possibility of Chesdog coming back on and giving us his half-yearly recap. So listeners, stay tuned for that one as well. All right, guys.
See you
Talk
guys.
soon. Thanks.
Thanks, Chris.
Thanks for listening. And now for our disclaimer.
This material is for your private information and does not constitute legal, tax, or investment advice. There is no representation or warranty as to the current accuracy of, nor liability for, decisions based on such information.